Bottom line here, the house view from Emirates NBD is that consumer activity, non-oil growth, still looks pretty constructive for our part of the world in the second half of the year. Is that correct?
Yeah, absolutely. Non-oil growth is, again, it's organically doing fine because the leadership is doing exactly what's needed. Companies are coming, investing, and non-oil growth is absolutely fine. And when it comes to oil, I mean, it's been a trade-off between price and volume, but the contribution of oil will be positive as well there.
Indeed. What's also interesting is that from an equity market perspective, it seems as if a lot of that optimism is also being priced in. Are markets correctly pricing not just the geopolitical risk, but also the inflation risk stateside right now? Do you think this optimism in the equity space is justified?
It's an absolutely crucial question. The first half of the year has been very good for markets, for all markets. We've seen this huge rebound in stocks after a collapse. And the lead is from emerging markets, which, by the way, we believe is very rational. Our positioning currently is slightly defensive overall. We are defensive because, as you mentioned, valuations are rich and we have lots of uncertainties that are probably not priced in by some sentiment indicators in particular, like the VIX, this kind of thing. However, we're only slightly defensive and we are actually underweight on stocks from developed markets, but overweight on emerging markets, only slightly because, yes, sentiment is positive, but I'm not sure that the positioning of most global investors is actually overexposed. I think it's the opposite. Many people are still chasing the rally. They are not fully exposed. And in our scenario, we will have some monetary easing ahead. So it won't last forever, but for the time being, defensive, but only slightly with a focus on emerging markets in equity.